Hello and welcome back to the Art of Finance. Today I just wanted to discuss a few things about seeing your profits actually go in the red. So for the first time I actually saw my Coca-Cola stock drop into the red by minus £20, and I just wanted to explain to everybody what to do in a situation where you see your stocks drop into a negative, so you're at a loss. So what you need to understand that time in the market is very, very difficult. And what really matters is the time held in the market. That is the most important thing that matters. For people that try and time the market, buying on the very lowest and selling at the very high, even the most experienced people can't even do that. Whereas the majority of us are just average people, so it'll be very difficult for us to even try and attempt to do that. And what is best for us is to put our money in and just go for the long run. Going for the long run minimizes your risk, so you will see many highs and many lows, but usually over a 5 year period you can gain up to a 8 to 11% return. And now I just wanted to talk about what to do when you actually see your money go into a loss. So the key thing here is to buy on the dips. So this is a long-term investment strategy where you start in buying, and the strategy that I'm taking out right now is investing month by month. So no matter what happens in the market, I'm investing month by month, if it's high or if it's low. Now you may think to yourself, well, why would you do that? Why would you not just put in a one lump sum at a low price and sell at a high price? Well, the reason being is that it's very difficult to do that and to predict the market, thinking that if I buy here, it's going to be very, very low. But you never know when you put that lump sum in, the market might drop. So you could lose a considerable amount of money. So with this strategy, the market might be at its highest peak and you don't want to put in a big lump sum. So what you could do is start drip feeding a small amount of money every single month so you could get started and start making your gains. Now, a lot of people who are beginners feel like they need to get in at a very good time, but they just need to understand the longer you wait, the more you'll miss out. And as time goes on, you'll think back, oh, if I invested a couple of months ago, I would have made a lot more money. So that is a big reason why you need that's why you really need to get started. Also, one of the biggest keys, of course, is buying low and selling high. Also, even though if our account is in the red, the biggest thing with this portfolio is that we're trying to gain dividends. And with dividends, we're just having our money held into our account. So when the company such as Coca-Cola pays out, for example, we will get that monthly, quarterly dividends. So regardless if it's in the red, it doesn't really matter, because once you're getting that dividends, it's like a snowball effect. As soon as you get that dividends in, and using a platform such as Trading 212, you could put that money in straight away. So slowly but surely over time, that snowball effect gets bigger and bigger, because essentially dividends is basically free money that you can reinvest into your portfolio to make it grow bigger and bigger. Now, at the very start, this is you will get very small amounts of dividends, but over time, investing that small amount would gather up like a snowball rolling down a hill. It will get bigger and bigger and bigger, and then you'll thank yourself in the long run. Oh man, thank God I started investing my dividends back into my portfolio, because it's only making your portfolio gain. Now, I also wanted to touch upon on why it's also important to diversify. I would also go into more depth later in a different video, but I wanted to explain a bit of diversification. Now that we're in a pandemic, we need to understand that there's a lot of ups and downs. So when there's a pandemic, with a lot of news going around, a lot of false news, a lot of terrifying news that goes around, a lot of death rates, for example, what happens is it affects the market. The media directly affects the market of what is happening and the performance of the market. So just a couple of days ago, that there might be a second wave happening. All of a sudden, a lot of stocks crash, so because people are panic selling, and that's something you don't want to do. And that's why diversification is so important, because if you only have your money invested in individual stocks, they will tank and you will feel a big hit. Whereas if you've had your money in for example, a index fund or mutual fund, then you will see that it doesn't really affect you in that sense, because you have a holding in so many different companies exposed to so many different industries that you won't feel this effect. Such as my Vanguard account hasn't really felt the effect of the coronavirus dipping quite vastly like my individual Coca-Cola. So I've seen my Coca-Cola stock only a couple of days ago at £20 up, but today, or even just last night, I was down by £20, and that is because of the coronavirus and not being diversified. Whereas my Vanguard account, which is diversified, I haven't really seen a fluctuation, because my money is so spread out in many different holdings that everything sort of balances out. So I just wanted to pretty much briefly touch on that. It's coming up to the end of the month as well. I'm going to make another quick update of how my account is looking, but I thought this is quite an important topic to talk about, and I thought it would be good to let everybody know. Thank you for listening. Please drop a like, comment and subscribe. If you have any questions, please drop it and I'll do my best to answer it. Thank you very much. Have a nice day.